Welcome back to the Hidden Money Podcast. Kevin and I are in studio again today. Today we are going to talk about something near and dear to us. S Corp strategy secrets for small business owners. Self-employed people. It's needed. It is one of the most often missed opportunities Kevin and I see just working with everyday potential clients, or walking in the street or going to a business meeting. Please stay tuned for this. Focus. Pick up these amazing secrets to help change your life by changing your tax.
Yeah, and I see this often kind of when people transition from a W-2 job to being a contractor, or being a business owner now. It's very easy to just be a sole practitioner or sole proprietor and report all your income and expenses right on Schedule C, because that's what sole proprietors do.
Yeah.
You just report it on your 1040 and mosey on down the road. It's very easy. It's also very easy to overpay your tax. That's super easy too. I mean, just
too easy.
Yeah, we see it all the time. So it does take a little bit more work and effort and strategy and thinking, but it's not overly complex. And then you have CPAs who do this all the time, who can actually enact this stuff and prepare the tax returns for you. But S corporations are the number one thing I want to look at when someone's transitioning from a W-2 to a 1099.
As a matter of fact, this is the first question we ask anyone that we're interviewing to come join the firm. If they can't figure this one out, they've been in the business for a few years, we generally don't have a second interview with them, right?
Yeah.
We say, if you're a sole proprietor, a client walks in, he's a sole proprietor. He made $200,000 in income last year, reporting it on his Schedule C. What can you do to change that? What can you do to improve his tax situation? Let's talk about self-employment tax, because this is the big pain point that S Corps help alleviate. If you are working in a W-2 job for any employer, you have two kinds of taxes taken out of your paycheck, actually more, but two main ones, right? You have your income tax. They do withholding for you, and they pay it to the government on your behalf, and it's prepaid tax. It's your paid income tax in during the year. But then there's Social Security and Medicare, or FICA taxes. The employer withholds generally 7.65% of every dollar you make. They take that from your paycheck before they send it to you. They take 7.65%, but then they're required to match another 7.65%. So I know it's a little complicated arithmetic here without our 10 keys, but that's 15.3%. 15.3% of every dollar you make. Boom! If you're self-employed, you're paying that to the IRS if you're a sole proprietorship. And then you got to pay income tax.
Mm-hmm. This is on top of it. So self-employed people, you still contribute to Medicare and Social Security, whether you like it or not, like those programs or not. You're required to contribute to Medicare and Social Security if you have active income like that. And the S corporation shields some of that burden, because what happens is, let's say you make $100,000 as a contractor and you're just a sole proprietor and reporting that on Schedule C. And let's say that $100,000 is your take home, your net, because you're taxed on your net, not your gross. So after expense, your net is $100,000. You're going to pay income tax on that through your normal, ordinary tax tables. Then you're going to pay that 15.3% on that 100 on top of it. That's $15,300 going to Medicare and Social Security systems. So what an S corporation does, let's say you take that same $100,000 and move it through an S corporation. S corporations are not subject to any self-employment tax, but you can't completely bypass Medicare and Social Security again. You have to play the game a little bit, but the way you play the game inside of an S Corp is you set yourself up on payroll, which, Mike, you just kind of went into. If you're a W-2 employee, you're paying Medicare and Social Security as well. So let's say you run that $100,000 through the S corporation. We might set your salary at $30,000 or $40,000, whatever is reasonable. We can get into reasonableness of compensation, because that's a very key component of this. But let's say your reasonable comp is $30,000 inside the S Corp. You're going to pay your self-employment tax, your 15.3% on the 30. Then the remaining 70 left over is only subject to income tax. So now your true tax savings, just from when we're looking at self-employment tax, is 15.3% on $70,000 in this just very rudimentary example, just to grasp it.
Let me rewind a second, just go back over this and make sure we're drilling in and hammering in this important material. If, let's say you're married, your spouse makes some good money, and then you have decided you're going to go out on your own and you make close to 200 grand, but all of your taxes are paid at 37% because your combined income with your wife has put you over that threshold, or your spouse. That means 37% income tax, 15.3% on the first about 170 grand self-employment tax. That's 52.3% in tax, more than half. Not counting state income taxes if you don't happen to live in a great state of Texas or one of the few other states that don't have income tax. You want to give the government more than half of what you are working hard to make? No. But another very important point we have to make here. Tax law is very, very clear and very explicit. You are not allowed to create an S Corp just to save an SE tax. That can't be your motivation or your primary motivation. So let's talk about another really good motivation to create an S Corp. If you haven't been in business for at least 2 full years in S Corp, and even if you have been, you own your own business, your own S Corp, or your own sole proprietorship, you own any business, you try to go get a mortgage, it gets a little difficult. They don't do just the standard W-2 applications. It's harder to get lendability. Not impossible, but harder. If you have an S Corp, you're paying yourself a W-2, you're able to pay in an S Corporation, you're allowed to pay yourself, you're required to pay yourself a reasonable wage via W-2. If you're a sole proprietorship, you can't pay yourself a W-2. At least you're not supposed to. So that is a great reason to do it. And then it so happens you're not paying more than half of your income to the IRS. You can reduce your SE tax.
Or to government programs that you don't really align with. I don't want to pay to Social Security. I oddly enough, I logged in to my Social Security account. Have you ever logged in?
Once.
You can see your work history
Yeah.
from whenever you first started and see how much in Social Security and Medicare you've paid.
It had my bag boy job back when I was like in 7th grade. It's in there. It's amazing in the early 80s.
It's crazy because I've held a job since I was probably 14. Just, working at Kmart and working at all these odd jobs at restaurants and all this stuff. And it has it. Then they actually have record. I can see my history of my work history all the time since I was like 14 or 15. And at the very bottom, it tells you your total taxes paid, Social Security tax I've paid, and total Medicare.
Ouch. I don't even want to know.
Hundreds of thousands of dollars that if the government allowed me to take hold of that
and just put it in the S&P 500,
it could be worth $300,000 to $400,000 right now, but instead it's going into this abyss. So if you've never logged, this is just a fun exercise. If you're like, I don't know if an S Corp is for me, go to your Social Security account. Go to Social Security. I don't know what the website is, .gov. Just Google Social Security, create an account, log in, link it to your social, and you will find your work history and you'll see how much you've paid into those 2 programs. It should shock you.
And if that doesn't get your attention, to go back, rewind this podcast and learn this stuff, I don't know what will.
Yeah, no, but you could stop. So you and I, we have our own S corporations too.
We do.
Every dollar that we make is active and earned income, and I don't want to pay to Medicare and Social Security. Now I'm paying my reasonable share. I'm not skirting the system, but at the same time, I'm not tipping them. And so we funnel everything we can, as much as we can, through these S corporations. Before it hits our personal returns.
And it can be aggressive, but the way Kevin and I mitigate is we pay our W-2s at the max amount to where, this changes every year due to inflation. Right now, about the first $170,000 you make, whether as an employee or self-employed, is subject to payroll tax, both Social Security and Medicare. Once you get over that threshold, it's only subject to Medicare at that point. So it does drop precipitously. So if you're one of the ways to mitigate this, I'm not saying it's the best way, and that's not everyone needs to do this. But in our case, we pay the amount, so we're maxing out our Social Security, even though it hurts. I mean, it's the law. We got to follow it. But we do a lot of other things legally to make sure we're not overpaying our taxes.
So that's the biggest aha moment with the S corporations is legally trying to limit the amount of Medicare and Social Security tax you pay. And it's not as simple as that, especially in a year where you convert from a W-2 to a S corporation or to a contractor. Because one of the secrets here is you may not need the S Corp right away. So let's say you're making $200,000 as a W-2 earner, and let's say in August you transition to being self-employed. Well, you've already almost maxed your Medicare
And Social Security.
and Social Security all the way through that August time frame, because you're going to hit the 170 cap. So now every dollar you earn after your W-2's already capped you, every dollar you earn going forward, you're only going to pay the 2.3%.
Yeah. 2.7.
2.7.
1.45 times 2. 2.9. It only took us 3 times. CPA's
2.9.
2.9. Let's talk about, before we get more into the S Corps and why you really should consider, especially if you're self-employed, some of the not so wonderful benefits or requirements. If you have an S corporation, you're required to file a separate tax return each and every year. Where if it's a sole proprietorship, it's just a schedule attached to your personal 1040. If you're paying for someone to do your taxes, you're going to be paying at least double, most likely, because you're paying for 2 separate tax returns. As an S Corp owner, you are required to pay yourself reasonable compensation via W-2, which means you have to run payroll. It's gotten a lot easier these years. There's a lot of bookkeeping firms that do it for you, but even if you don't want to work with a bookkeeping firm, you can go hire a company like Gusto. We use them for our own firm's payroll. And once you get it set up, you can set and forget it. They do all the filings for you, the payroll tax deposits, all that. But those are the 2 requirements you will definitely have when you create an S Corp.
Yeah, and here's a little secret. You don't have to keep yourself on payroll for the full year. You can, because all we're worried about is when you get to your S Corp tax return, when we file an S Corp tax return, there's an actual box that says officer comp. Officer comp is you're basically self-reporting to the IRS how much did you pay yourself reasonably as the owner of the company. If there's a number in that box that ties to your W-2, you're in good shape if you're just a single member. So what you could do is you actually don't have to remit your payroll January through November inside your own S Corp. You can save it, keep it for business, whatever you need to do. Then in December, you could bonus we could figure out your reasonable comp, because reasonable comp it's not just, what would you make in the open market? It starts there. What would you make given your position in the open market? That needs to be your salary in the S Corp. That's kind of where we start.
Or what would you have to pay someone else to do your job if you were going to be passive?
Yes, but then we also need to take into account cash flow. Because let's say you're a radiologist and the market demands I make $400,000 to $500,000 a year. Well, if my S Corp does not generate $400,000 to $500,000 of revenue, I don't think it's very reasonable I go take a loan to pay my payroll. That makes 0 sense. So cash flow is a big part of this. So you can hold on to your cash January through November, get with your CPA for that Q4 last December meeting, and then what we can do is generate the max that you should pay yourself in bonus that year to get your W-2 right where it should be. We're not overpaying throughout the year, because what happens if you set your salary at $200 and then cash flow issues come up or you overpaid yourself? What if we could have gotten by with less? Well, once you pay yourself a W-2, you can't unwind that. So just don't pay yourself January through November, and then calculate the actual true pinpointed amount with payroll in December and just do a 1 bonus check and then be done.
Yeah, and there's one more added benefit to that that's available to S Corp owners, is if you have happened to underpay by accident or for whatever reason, your self-employed withholding taxes or your estimated tax payments throughout the year, and you're going to face some penalties. If you pay yourself tax withholding through that W-2, even in the month of December, nearly every time you can get that to apply for the whole year and eliminate your potential estimated tax penalties. Let's go into this reasonable comp a little bit more, because there's a whole lot that goes in there, right? The IRS, tax law says all facts and circumstances need to be considered when determining what reasonable comp is. I hear over and over again, well, I spoke to my CP and he said I need to pay at least 60% of my total income in W-2s. Where's that come from? I see no law that says that. That's just being lazy.
Yeah.
That's not true. There are averages you can go back and figure out, But that's not tax strategy. That's
No.
not good advice.
No.
It's not a certain percentage. It's not a certain dollar amount. It's based on all of the facts and circumstances in your particular situation. If you're self-employed, you got a whole lot more things to think about than a W-2 employee at a big company, right? You got to figure out, what am I going to do to grow my business next year? What am I going to do to maintain our current growth strategy? What am I going to do to pay for that inventory in December for Christmas? There's so many more facts and circumstances that impact what's reasonable. And just those few things I mentioned are reasonable facts and circumstances to reduce or to change the amount that you're paying yourself. We could probably talk for 2 hours on reasonable comp. You and I have had a lot of those audits in our past, and we've studied a lot on that and read a lot of tax court cases. But don't take the general rule of thumb, especially if you have weird situations, if you have a lot of facts and circumstances that don't apply to everyone else. You've got a lot of maneuverability in that.
Yeah, reasonable comp. Yeah, like you mentioned, reasonable comp audits, they're not as common as they were, and not saying they couldn't pick back up. But the whole thought, let's say you make $1 million in your S Corp, and then in your S Corp tax return, there's $100,000 sitting in officer comp. That's probably not reasonable. So here's the risk. You get pulled for audit. They challenge you on that. They could revoke your S election if you don't play this right. So if you're drastically or not even paying into Medicare and Social Security via the W-2, they could just say, okay, well, we're just going to tax all $1 million is going to be subject to Medicare and Social Security.
And your S Corp is no longer in existence.
And you're revoked. And so then you're in big trouble. So that's the biggest risk here is sometimes you want to pay that tax. You have to, but you want to make sure you're paying it fairly because you're hedging your risk there. And very rarely do you hear us say, hey, pay your share of tax. This is one instance where it kind of makes sense to pay your share, but make sure you're doing it strategically and not just blindly doing a 60% coverage. That makes me as an accountant feel all well and good. If you make $1 million and your salary is $600, I don't have a reasonable comp audit. I don't have anything to worry about as a professional. You've paid everything you need. It makes my job super easy from the fact that it's lazy.
Yes,
it's
lazy.
extreme.
And that means you probably overpaid your taxes. And then your tax strategist, lazy Kevin over here, who doesn't practice like that, got away with it, but you pay too much in taxes. Please don't do that.
Don't do that. But also don't pay yourself too little. Another secret though, and it's very cool trick. I like that secret where if you haven't paid any estimated payments, just do a Q4 bonus and have it all go to withholding and it counts for the full year. That's a beautiful trick. Another cool trick is, let's say you have been an S Corp and you've been one for several years and you've never put yourself on payroll and you've gotten away with murder basically for the past few years. Well, let's say it's time to file, because right now we're in June of 2025. So it's the 2024 filing season. We're filing for 24 tax returns. Let's say we get an S corporation that made $500,000 and there's no officer comp.
This actually happens more often than you
Very
believe
common.
With new clients we get.
Yes, very common.
We get it. We're looking at their S
Corp.
Corps and they've never paid themselves a salary. And we're like, you haven't gotten audited yet? How can we fix it? It's too late to go back and pay yourself W-2. It's June already.
Yeah, we're in June of 25. You can't go back in time, pay yourself that salary. So what we do is, and this is all fair, you could put, let's say they made that $500,000 on an S Corp. We could put a $200,000 number in the officer compensation. We move it out of distributions because when you're reporting your balance sheet, everything has to balance, hence the term balance sheet. So you have to move it out of your distribution account, the money they've taken out of the S corporation. You just reclassify it to officer comp line on the S Corp. Simple enough there, and it's reducing their taxable income on the S Corp. Now, when you get to the 1040, that's all well and good, but nothing's really changed except you've moved numbers.
And if you don't do the second part, you might get in trouble for having moved those numbers.
The second part is where the actual crux is.
Yes.
The first part, that's just a journal entry to make sure your compensation's at least there so you're not triggering audit. The second part is when you get to your 1040 tax return, you go to a Schedule C, you put that number that you put on the officer comp that you reclassified from distributions, you put it directly on the Schedule C, and you actually have it calculate self-employment tax on Schedule C. So you're paying your Medicare, you're paying your Social Security tax. It's just not through a formal W-2 or payroll. Instead, you're doing it just via the Schedule C. Government's not out any money. You're reasonable. You've paid your tax, and that's a way to really save your hide if you've never paid yourself salary and you're filing a tax return.
And we do that a lot, but let me give this disclaimer. There's actually no authority that exists within tax law, treasury regulations that allow for this, but there's so much that you do that is not in the regulations. What you're doing basically is you're saying, hey, government, I recognize I made an error, so I'm going to make it right and make sure you've gotten enough tax pay, because that's all they care about. And even, I don't know how many dozens of times we've done that, Kevin, but not once have we ever. And there's been a few times where those clients got audited, but not once did they get mad about
it.
What's
the IRS's argument? They're going to come in and be like, where's your payroll?
Right.
I'm like, it's right here. Well, okay, well, what's the net hurt?
I did have an agent tell me once, make sure it's on W-2 going forward.
Yeah.
But
this is a one-time
This is
like a
mitigation.
Band-Aid, like break glass in case of emergency.
Yes.
It's kind of like you have a substantial amount of S Corp income. You've never paid yourself salary. Break the glass, do that little roundabout way, satisfy the government for that year, but to get yourself on payroll going forward.
Yeah. In the few minutes we have left, I want to cover two more topics. The one is the pass-through deduction, or 199A deduction, or it's got a bunch of names.
QBI.
The QBI deduction. There's a couple more names. But that has complicated S Corp, reasonable comp, and figuring out what to pay, because you're allowed to get a deduction. If you have your own business, if you're a sole proprietor, you're allowed to take the full 20% deduction of your net income from your sole proprietorship.
Could be 23%.
Hopefully it will be 23% when the BBB passes. Whether it's 20% or 23%, you want that QBI deduction. Sole proprietor making $200,000 net a year on your Schedule C, you get a $40,000 deduction. You put it in S Corp, and let's say you only pay yourself $40,000 of W-2 salary. You don't have any other employees, and you're making the exact same amount of income. Now you're only allowed to deduct $20,000 instead of $40,000. So you got to be careful with that. The rule on 199A is you're limited. There's actually a bunch of limitations, but the main one we're focused on here is you cannot take more of a pass-through deduction than 50% of the qualified wages you paid. Not 1099s, not contractors, but W-2 wages. So you want to make sure your W-2 is high enough. We do this with all of our clients because you never know exactly what the amount is in the beginning of the year, but that's our exercise in November and December with our clients. We figure out how much you paid yourself. How much have you paid your other employees? What's your potential 199A deduction? Do we need to bonus you? Are you good? Be thinking of that.
Yeah, because you can come out ahead doing this by paying more in payroll than you normally would. Like, if this is going for like closely held S corporations where you may be the only employee, you may be just a sole proprietor S Corp. If you have other employees in your W-2, and you probably already hit this cap. But the thought being, what if your salary is already at the $170,000 mark? You're already capped on a lot of your payroll tax, but to maximize your QBI deduction, we need a $300,000 payroll because you're making $1.2 or $1.4 million. Well, you're going to pay a little bit more in payroll tax, but you're saving for every dollar that you're paying in payroll tax, you're saving well more in QBI deduction at the ordinary tax rates.
Yep.
So you're going to be paying a little bit of payroll tax, but getting an ordinary income tax. Because remember, you're paying those two taxes. You're paying income tax and you're paying employment taxes, your Medicare Social Security. So we'll pay a little bit over here to save a lot over here. There's a big difference. So make sure this is all part of tax planning, and it's a little bit more advanced, but that's something like you said.
There's not a perfect, easy formula you can just apply. You've got to analyze it. You've got to walk through it. There's a break-even analysis that needs to be done.
But that's exactly what a strategist, that's exactly what we do. We tell all of our staff to do that. And so we're making sure we're maximizing our QBI, because now it's even more beneficial if this bill goes through at 23%. Your savings go up even more. And there's other traps in the QBI deduction, specified service trader businesses and things like this. But generally speaking, your payroll should be healthy enough to keep you out of trouble with the IRS for reasonable comp, and it should be healthy enough to maximize your QBI deduction. If you take two things away, it's those two things, outside of creating your S Corp to shield some of that SE tax that you're required to pay.
Yeah. We're running out of time on this episode, but I do want to get into, how do you create an S Corp? What is it? How do we do it? And when should you do it? The normal way to create an S Corp is Within 60 days of the starting period of your S Corp, generally within 60 days of January 1st, right? Or when you create a new entity, you have to file the S election form 2553. You just file it, you send it in. There's a fax number now, you can fax it in, and you usually get approvals much faster when you used to have to paper file them in. But let's talk about most businesses. Here, I got to give this disclaimer. Kevin and I are not licensed attorneys. We are not attorneys. We're not qualified to offer legal advice. It's against the law for us to offer legal advice. Please consult with your attorney when you're creating any type of entity, because a big reason you're doing that is for liability protection, which we're not allowed to address. But from a tax perspective, you have new clients coming in. Hey, I've been W-2 for the last 10 years. I know I can do this better on my own. I'm starting this business. Do I create an S Corp election now? Well, you could. But what if, because remember, now you have to file 2 tax returns. You have to pay payroll. What if your first year, you're just getting up and running? You haven't hit the ground and you got a net loss. You don't necessarily want an S Corp for a net loss. Or you're only making 10 grand in profit. You don't need an S Corp. It's not worth all that other stuff. What I prefer and what I recommend, but do consult with your attorney, but from a tax perspective, create a single member LLC. You're the only owner of it. With a single member LLC, you have multiple options of how you file on your tax return. By default, if disregarded entity, it's just considered a sole proprietorship on your tax return. But if you have that LLC, and that's the important part, get it created as soon as possible. Let's say you thought it was going to take you 2 or 3 years to get your business up and running and really start making money. Let's say come September, October, you have hit it out of the park. You got $500,000 in income. And then you realize, oh, goodness, maybe I need to do that S Corp thing. Guess what? It's not too late if you created that LLC. There's something called a retroactive S election where you're allowed to, as long as your LLC was created, you can go back and start it or recreate it as an S Corp retroactively. If you didn't form that LLC, you can't do it. The other thing I like, and again, purely from a tax standpoint, again, you got to consult with your attorney, is always start with an LLC and then elect to have it taxed as an S Corp. As Kevin was talking about, reasonable count. Let's say you just created a corporation, a C corporation. You created it and then you filed an election to have as an S Corp. The IRS takes your S election from you. It's going to revert back to what it was originally. And very rarely does it make sense to have a C corporation. So it could hurt you badly. But if you lose your S status, or maybe you want to stop being an S Corp for good tax planning reasons, go back to being a single member LLC or even a partnership, you can do that if you started it as an LLC and filed the election to be taxed as an S Corp. Anything to add to that?
That's good. Sometimes we do revoke with a simple letter to the IRS S elections. There's reasons we do that.
Good reason.
Oftentimes it's ownership changes, because one thing we didn't hit on, there's 2 things I want to hit on. Ownership changes inside of an S Corp, or if you have multiple members in an S Corp, you have to distribute money out of an S Corp at your ownership percentages. No ands, ifs, or buts. If Mike and I were in the same S Corporation, which we're not, and let's say we were 50-50 partners in an S Corp.
Mm-hmm.
And I decided, I'm not going to work this month, but you worked your butt off and you generated $300,000 to $400,000 of revenue in our S Corp that we started together. And you're like, hey, I'm going to take my distribution from what I earned. You were on vacation all month. I'm taking my cut. Wrong. Can't do that.
Yeah,
you're going to be
50,
splitting
50,
those profits with that person 50-50, no matter what the circumstances is. Partnerships are different. If you're in a partnership, then you can allocate distributions and income however you see fit, so long as it's within the guardrails of the operating agreement. So that's a trap inside of an S Corp if you're with multiple people. So S Corps don't always make sense, but there's ways to structure it where you can have a partnership and S Corp interests own inside of a partnership and allocate. We can help you with all the entity kind of structuring.
The other limitations for an S Corp, you can't have it can't be 100 owners or less. You got to have actual people that own it. You can't have entities that own your S Corp unless you do the Q-sub election. And you can only have one class of stock, which again goes to this whole partnership difference. One class of stock means everyone gets the same treatment. Every shareholder gets the same distribution percentages. Every shareholder gets the same voting rights. That doesn't always make sense. S Corps, if you're a service business and you're the only person owning it and running it, it probably makes good sense for you. Again, you got to be careful. That's a specified service trade or business. But those are the general rules. There's always a lot of caveats here, but generally speaking, those are the rules for an S Corp, how you get it created. You should always consult an attorney, and this is general tax advice. Don't just watch this podcast and say, okay, I'm going to go start an S Corp. Make sure you talk with a tax strategist and probably an attorney too.
Yes, because every circumstance is different. Our podcast, we just like to be educational. We just like to bring things out to the general public. Then you have to take this and you have to kind of funnel and filter it for your situation, just because everyone's different. And if tax law was an easy blanket we can cover everybody with, it would be really easy.
Wouldn't that be nice? Yeah. We just have a spreadsheet. We wouldn't have to work anymore. We wouldn't have to train our team on how to do tax advice.
Correct.
You'd have a spreadsheet and say, go check these boxes, and that's your tax plan.
Just have robots do it.
It doesn't work like that.
The last thing I want to touch on one thing never to do. This is a secret. I don't know if it's a secret. I've seen it done enough times where I feel like there's some hacks out there that are doing this. Do not put real estate inside of an S Corp, please, for the love of God. Do not put real estate inside of an S Corp. Okay. Maybe 1 out of 1,000 reasons I can see maybe doing it, but generally your real estate income's not subject to any employment taxes. Then you're just creating basis issues. We didn't even get into basis. Basis is such a huge thing inside of an S corporation because we probably just need to do our own podcast on it.
We should do that one.
Don't put real estate inside S Corps. S Corps are for active trader businesses that are generating self-employed income, passive investments that you're going to be maybe doing some depreciation or aggressive tax planning with. You don't want it in an S Corp, especially if you're going to be leveraging, buying assets. You might want to look at the S Corp and see if that makes sense as well. Debt is always weird inside of an S Corp when it comes to the deductibility of those items.
Yes. Then that is a general rule. I'd say it's more like 1 out of 100 times that I've seen where it makes sense to have real estate, not 1 out of 1,000. But
I just don't.
I've seen it a dozen times in my entire career where it made sense to have property in an S Corp. And 99.99% of the times when someone comes to us and they have property in S Corp, it is a big problem.
It's a pain in the butt to get it out.
It is not just pain to get it out, but it eliminates or greatly prohibits them from being able to do the tax planning they could do with that property that's theirs. They listen to some TikToker telling them to put it in this S Corp, and now we got to unwind this mess. And we get paid well for that, but it's not money well spent, in my opinion.
No, it's fixing a mess.
Yes.
I don't want to fix a mess. I want to strategically plan. But I guess we could look at it. That's planning. But
it is planning. It's just the cost that you're going to incur that you shouldn't have had to. So take Evan's advice. Don't put real estate into an S Corp unless you have a really good reason for it and you've talked with a tax strategist. Thank you, everyone, for being here. We hope we've helped share some of the cool secrets of S Corps. There's a whole lot more. Hope you enjoyed it. Make sure you like and subscribe. It will help us continue to grow the education. We want to change the way people see taxes. Taxes can be the greatest benefit in your lifetime, not the greatest hindrance. We want to change the world to get people to understand that. So please like, please subscribe, and tune in next time for our next episode.